This is a real quick video on the relationship between win rate and reward to risk. So I've mentioned this throughout the course, and especially in the last couple of videos. We want to maintain that reward to risk ratio because it's pretty much paramount in terms of our profitability. So I just wanted to go through a couple scenarios, and then also we can talk about the relationships a bit more and how to find potential errors in your trading and where you could find areas of improvement. So as mentioned throughout and in the strategies, I typically use a 2.5 to 1 reward to risk on most of the trades, and I'm going to risk 1% of my account per trade. So let's look at some scenarios with win rates, and then we'll include commissions. And the amount of your account doesn't really matter because we're looking at percent profit anyway. So if you can make 10% on a $500 account, you can make 10% on a $5,000 account. There is a limit to these strategies. We're using a 1-minute chart. So depending on your broker, how much liquidity they have at each price level is going to matter, because the bigger your account gets, we're using leverage. So once you get up to about a $50,000 account, if you're losing 30 times leverage, that means you're trading $1.5 million at a time. And some brokers may not have that much liquidity at the price you're looking for, so your slippage isn't going to increase. So these, once you start getting up into a $30, $40, $50,000 account and you're trading millions of dollars of currency on each trade, you may start to notice a little more slippage. Might need to make some adjustments in these strategies. The reward to risk is going to become even more critical at that point. So something to be aware of. But for the most part, for most people who are day trading, most of your account sizes, these are going to be applicable to. Let's assume that we have a win rate of 50%. We have a $5,000 account. We're paying $5 per 100K commission. So that's a little bit on the higher side. The brokers in the US are typically charging this. If you're outside the US, you can get typically much lower than $5 per 100K. But let's just use the $5 because that's a good starting point. And on average, we're making 3 trades a day, so that's about 60 round-trip trades per month. We have a US dollar account, and it's also nice to know what your average stop loss size is, and you just can kind of estimate this, or you could actually add it up if you wanted. But typically, the average stop loss size is about 3.5 pips, 3 to 3.5. As I said throughout the course, most of our stop losses are going to be between 2 and 5 pips. So right in the middle of that's 3.5 pips. So that's what the typical stop loss is going to be, and that just helps us establish what our position size is, so that we can use that to calculate our commissions, because we need to know how much we're actually trading per trade multiplied by how many trades we have a month multiplied by our commissions to establish our commissions for the month. So we'll use this a little bit later on. So we're taking 60 trades a month. We're 50% profitable, meaning 30 of those trades are going to be losers. We're going to lose 1R on them, and I'm risking 1% of my account per trade. So 30 times minus 1%, my losses account for a minus 30%. But I have 30 wins, which are hitting a target of 2.5%, so my wins are 75. So I end up with a gross profit of 45%. That's with no commissions. Now, some people may say, well, on some trades you're losing 1.1, some trades you're losing 2.2 because of slippage, but that also works both ways, because sometimes my 2.5 is going to be 2.3, sometimes it's going to be 2.7. So this is why each week in my weekly reviews and my monthly reviews, I write down what the actual reward to risk rate is. And it typically ends up pretty close to 2.5 to 1, and if anything, it's usually a little bit higher. So this might even be undershooting a little bit, because there are those maybe 1 trade, 2 trades a month where we're pushing that reward up to 4 to 1, 5 to 1. So if we get one of those trades, that's going to help skew it a little bit above 2.5 to 1. and then we get the slippage sometimes favorable, sometimes slippage is negative. So all those little things tend to average out, and we usually end up pretty close to around 2.5 to 1. So even though each trade may not end up exactly like that, over 60 trades, the reward to risk usually ends up around there if you're taking your profits where you should be. Now we have to factor in commission. So on a $5,000 account, we made almost 50% with this strategy, assuming these conditions, but we need to now calculate our commission. So we're taking minus $5 times 1.2, because this is per 100K. So we're basically multiplying that by 1.2 times 120 trades. Yes, we had 142,000 was our average position size. If it's $5 per 100K, we have to multiply the 5 by 1.42 times 120 trades, because this is to get in and out. 60 trades per month is how many trades we took, but we had to get in and then we had to get out. So we've actually made 60 trades, but 120 transactions. So we've lost $852 in commissions. So we end up with a net profit, 2250 minus 852. We end up with this, or about a 28% profit. We divide this by our account size, 5,000, 28% profit. Now over here, I just put an alternative. If you can find a broker that offers you $2 commissions, we multiply minus 2 times 1.42 times 1.20. We save ourselves about $500 in commissions for this account size. And we end up, or if you just compare the percentages, with the $5 commissions, we end up with a 28% profit. With the $2 commissions, a 38% profit. That is a 10% profit a month based on commissions. So if you have no option and $5 is the only option you have, then by all means, we want to take that 28% that this scenario would offer us. But if we do have some choices, lower commissions definitely make a big difference. So as I said here, commissions matter. You could fill in anything you want here. So you could go, if you want to play with these numbers, you could take it up to 60%. That's getting a little bit higher. You'd need to be, probably trading these multiple months, many months, maybe even a year or more before you're getting up into that 60% area. You could change the account value. You could change your commissions. 3 trades a day, fairly typical for me, but you may have, because some trades you'll have 7 or 8, but other days you're going to have none or 1. So it's averaged out over the course of a month. And so this is going to be pretty typical, but if you're trading a little bit longer, maybe you're trading 3 hours a day, maybe you're going to have 4 or 5 trades a day on average. You could also change in your account. We had talked way earlier about switching currencies around, pip values. Your average stop loss, I would think, should be around this if you're following the strategies, but maybe it's a little more, maybe a little less. And your position size, you're going to have to figure out. So you can just plug in numbers here to see what your potential profit and win rate is. And it's a good idea to play around with the win rate. So try a 60% win rate with a little lower reward to risk, and you can see how much it affects it. Or bumping up your reward to risk to 2.6, 2.7. How does that affect? So we're going to talk about that later in the course, making little micro adjustments to your strategy, which could actually really produce huge differences over a month or multiple months. So play around with these numbers a bit if you want to, just to see what potential profit scenarios look like for your situation. And then ideally, once you start demo trading, you kind of want to see what, typically you're going to be making mistakes. And as I talked about in the prior video and what we're going to talk about in the next video called efficiency, you're going to see a difference between if you would have traded the strategies well, maybe you saw a trade after the fact, you're like, I should have taken that one. And you'll start to see that, so you can add up what you made and what the strategies made. And you can start plugging in the numbers for these strategies to see and to help motivate you to start adhering to the strategies. Because if you lost 5% over the last week, but you see that the strategies, if you had just followed them, made you 10%, there's a 15% gap between what you're doing and what the strategies produce. To me, that's motivating. When I actually add it up and I see, wow, all I have to do is get better at implementing these strategies and I can make 15% more a month. And I can do it consistently after that once I know these strategies, because I'm just following the rules. It's only when I break the rules that my performance really deteriorates. So I find that very helpful to just go through, add up all these numbers, and start plugging in what the strategy would have made based on the win rates you're seeing. So as you add up all those trades that maybe you missed, trades you shouldn't have been in, throw the numbers here for the strategy, and then throw in the numbers for what you're doing and see the difference. Here's just a few things to look at for reward to risk. If your win rate goes up, but your reward to risk stays the same, you are going to make more money because you're still making the same reward to risk, but you're winning more often. So of course you're going to make more money. If your win rate's lower while your reward to risk stays the same, you make less money. If your R to R drops, your reward to risk drops, and your win rate doesn't make up for it, you will make less money. This is a really big one because most people's reward to risk, when it starts dropping, will drop by like half. Like we talked about before, if you even start bailing a little bit early, your reward to risk drops from like 2.5 to about 1.5 or 1.75. Even on those couple trades I showed in prior videos when I got out a little early, my average win was like 0.2, 1.2, 1.3 on those trades. I was making like half. In order to compensate for that, your win rate now needs to go up by 50%. So if you were at a 50% win rate before, now your reward to risk drops, you're going to need to be up at a 75% reward to risk, a 50% increase over what you were doing before in order to compensate for that. That's difficult. You're talking about possibly years of work to try to increase your win rate up that much. Whereas, in my opinion, just leaving a trade alone and letting it hit your target is a far easier way to make money. So it's hard to compensate with win rate for a declining reward to risk. So I'd way rather leave your reward to risk alone or try to increase that than try to increase your win rate. And that's exactly the opposite of what most people do. They want to win more, so they sacrifice their reward to risk, which is the worst thing you can possibly do to become a professional, consistent, full-time trader, or even a profitable trader, period. If your reward to risk goes up and your win rate stays the same, you make more. Here's where I think most people should focus, is incremental improvements in the win rate. Like if you're down at 30, 40%, there's definitely room for improvement to get up to 50, 60%. Beyond that, it's going to get much more difficult. But you have that bit of room, so increase your win rate by just working on the strategies, reviewing your charts each week, but try to keep that reward to risk as high as possible, up near 2.5 to 1. If your reward to risk goes up and your win rate goes down, you still may make the same or more depending on whether the reward to risk offsets any additional losing trades. If I can increase my reward to risk, but I end up losing one more trade, I'm totally fine with that if I add it all up and I actually end up making more money. So if I find that I could actually go to a 3-to-1 reward to risk, I would do it taking on a couple more losses if that reward to risk offsets those losses and actually end up making more. And you got to go through your charts and actually see if that is a possibility. So we'll talk about that later in the course still. By understanding the relationship between reward to risk and win rate, you can often isolate your problem because these two things will point out a whole bunch of possible issues. And because almost all issues are going to affect your win rate or your reward to risk. Just track whether you get out of trades early and how much has that cost you. Or maybe your problem is you're actually getting a little too greedy and you're always going for 4-to-1, 5-to-1 reward to risk, and they're just never hitting, and then they always end up hitting your stop loss. So your win rate's hurting you, but that's also telling you your reward to risk ends up being low because you're always losing and you have very few winners, even though you're actually trying to go for a big reward to risk. Does that make sense? Like, if your reward to risk never gets hit, if you're going for big profits and they never get hit, that's detrimental. You need a reward to risk that actually gets hit with a decent probability. So, 40, 50, 60% win rate. And these are both just interchangeable. We can see how they work together here. So just by looking at these things and saying, okay, I was down last month, what happened? Let's go through my charts. This trade I bailed on early. This trade I bailed on early. This trade I bailed on early. I add up all those. Oh, I'm actually profitable for the month. So it's not I was in the right trades, so win rate's not the issue. It was just I kept bailing on trades early. So my reward to risk ends up low. That's why I'm down money. Or you just look at your trades and it's like, this one immediately went against me. This one immediately went against me. This one immediately went against me. So win rate's the problem. You're losing lots of trades. They never went in your direction. And you have poor entry points. What's going on there? So these are the types of little clues we can look at to just help improve our trading by going through our charts. This is the type of stuff, thinking about this stuff, seeing where the problems are, is where people should be spending most of their time when they learn a strategy. Like, yes, you need to learn the basics of the strategy, but once it's kind of in your head and you can see it on the chart, all this is going to take up like 90% of your kind of practice research time. Whereas most people make the mistake of just, okay, I'm not doing very well with this, I'm going to go try to learn something else. And then the same thing happens. They look at the charts, maybe don't do so well, and then they move on to something else. The real understanding, the real, holy grail of trading is understanding these connections and just then looking at the trades you're taking and saying, how do I make myself better? Based on what I know, what I'm trading, how can I tweak this a little bit? And it just has something to do with this. You're bailing on trades too early. You're not following the protocols. You're taking trades that you shouldn't be, that aren't part of the strategy. And once we isolate those, we can start improving our win rate and our reward to risk and getting into, these type of profit scenarios. We're also using high leverage. Notice this is what makes these returns possible. I should point this out. 1.42 loss. That's $142,000 on a position. You have a $5,000 account. So we are looking at greater than 20-to-1 leverage, maybe even like 25. About 28-to-1 leverage. So that's what's making this return possible. Without leverage, you'd be up 1% for the month. Because we're using 28-to-1 leverage, basically that 1% profit, all those tiny little movements we're capturing equate to 28%. That's what makes these returns possible. It's the strategies are good. They're built, designed around this, but we are using leverage extensively. So that's why these types of returns are possible. As I've said before, it's easier to increase reward to risk than it is to improve win rate. And by that, I mean improve your own win rate, because most people are going to bail early on trades when they're starting out. And if you can just get up close to that 2.5 to 1, where you're getting out at -1R and you're taking your profits at 0.25R, that's where we just want to get up to. If you can get to that 2.5R win rate, that eliminates a whole bunch of, or 2.5R reward to risk. If you can get up there, that eliminates a whole bunch of other problems, because now you're sticking with your trades. We are utilizing that edge, and then all we need to work on now is getting the win rate up so that we're in that 40% and up ballpark, because at that point we become profitable. And then it's just looking through the charts again. Okay, how can I improve this entry? I'm always late. How can I work on this? I need to work on my commentating the price actions, that I'm always ready for the trade, so I'm not entering early, or I panic. I'm afraid I'm going to miss it, so I enter after the price has gone past my entry point. Whereas, Corey mentioned a video or two back that I should just be putting out a limit order. If the price has gone past the entry point, put out a limit order, wait for it. Maybe the price comes back and fills me, but that's the only way I'm going to get my win rate up, stick to my reward to risk, and those are the little micro changes that are going to make it profitable. So that's a little bit more on reward to risk and how you can use them to improve your training just by looking at those two very simple things. And if you want examples of this, let's see if I can pull up. So on Trade That Swing, I have my weekly strategy reviews. And so it shows the potential R for the week. It shows the win rate, how many wins out of how many trades there were presented. And then I also add up the reward to risk. So I add up all the winners. So how much did I make R-wise on all my winners? So 2.3, 2.51, 2.5, 2.75, 2.97, 2.8, 2.5. And you add these all up divided by how many trades there were that were winners. So we can see my average win, 2.36. That's not the end of the equation. That does not tell me what my reward to risk is. I then need to add up all my losers and divide by how many there were of those. So 1.2, 0.69, 0.87, 1, 0.65 divided by 5. We divide 2.36 divided by the average loss. So my reward to risk is actually 2.71, 2.7 to 1 this week. Is actually above 2.5, even though my winners were actually only 2.36 on average. It's because my losses were actually a little bit lower. If we go back, let's go back to another week. So this is how you can calculate those. The win rates is just how many wins out of how many trades you took that week. And then winners, you just add them up. So in this week it was 2.445 for my wins, just adding them all up, dividing them. There were 6 winners. So add those up, end up at 2.44. We add up the losers, and looks like I maybe had a flat trade in there. So a flat trade, I consider that a loss because I paid commissions on that trade, but it's actually reducing I count it as a loser, but it's reducing the size of my average losses. I also had one that it looks like I got out a little early on. Maybe we had a transition of patterns, so I had to get out of that one early to get into another trade. And so we divide 2.445 divided by my average loss, and we can see this one's way higher, 3.6 to 1 on average this week was my reward to risk. That's what each trade I was going for 2.5, but in actuality, after the trades ended and my results were in, this is what my actual average reward to risk ended up being. So really important to stick to the rules, because this is huge. If you throw this in, we're getting that's a pretty good reward to risk. Also look at other things. Did I, what missed trades cost me, other mistakes, things like that. So you can look at these for some examples, and I hope to continue publishing them in the future, assuming my schedule doesn't change too much. But you can always go back in time and just see some examples of how to calculate these out. So that's, just how you can merge win rate and reward to risk. And I calculate those each week just to see where I'm at. Next video, something that I've been mentioning a little bit the last couple videos, efficiency. Just looking at the difference between how you're doing and how the strategies are doing, because they're very different. If you're trading different than the strategies, we need to merge those two up. And so we're going to look at how we can do that.